Welcome to the Nifty Noon podcast. This week, we are looking at how traditional Wall Street banks basically decided to slash their trading fees to almost zero in this predatory strike to steal crypto's best customers.
Yeah, but instead of fighting back in the trading pits, the biggest crypto exchanges are doing something completely wild.
Right.
They're just buying up the underlying plumbing of the global financial system.
Which is such a massive pivot. So, let's set the table for you, the listener, right? In today's deep dive, we're going through a stack of daily briefings from our newsletter spanning this past week.
Yep, May 4th through May 8th, 2026.
Exactly. And the dominant theme pulsing through all of these sources is this definitive shift away from pure token speculation.
Toward a desperate sprint for real-world structural utility.
Yeah, specifically the battle over stablecoin rails and permissionless prediction markets.
I mean, to truly grasp the magnitude of this shift, we have to look at the chain of causality here, because this wasn't just a bunch of random press releases.
No, not at all.
We saw one massive regulatory domino fall on Monday, right? Which sent a shockwave through the developer ecosystem, triggered a massive venture capital response.
Invited a Wall Street attack.
Yes, and forced a billion-dollar pivot by Friday.
So let's follow that exact shockwave.
Yeah.
Because the spark that lit the powder keg happened on Monday, May 4th.
Right, the regulatory breakthrough.
Yeah, the big news broke that U.S. Senators Tom Tillis and Angela Alsobrooks finally hammered out a compromise on the stablecoin yield provisions of the Clarity Act.
The Digital Asset Market Clarity Act, which, yeah, everyone just calls the Clarity Act. It had been stalled out in committee since January.
Right, and the mechanics of this compromise are basically what dictate everything else that happens this week.
Exactly. Because for years, the industry operated in this weird gray area regarding stablecoins, right? Those digital tokens pegged to the U.S. dollar. Under the finalized text of this bill, crypto companies are now strictly forbidden from offering yield to U.S. customers just for, holding stablecoins in an account.
Which means they can't act like shadow banks anymore. Regulators don't want you parking your digital dollars on an app, doing absolutely nothing, and watching a 5% interest rate tick up.
Right, just like a traditional savings account.
Yeah, because that encroaches on the territory of traditional depository banks, which are, heavily regulated.
And insured. So that passive buy and hold yield model is completely dead.
Wow.
But the legislation does preserve the ability for these platforms to provide rewards based on bona fide activities.
Okay, so what does that mean in practice?
Well, they explicitly carve out protections for things like network staking, governance participation, and loyalty programs. So regulators are basically forcing a pivot from buy and hold to, buy and use.
Okay, that actually reminds me of the underlying mechanics of high-tier airline credit cards.
Oh, yeah, that's a good analogy.
Right. Think about it. Delta, or American Airlines, they don't hand you free flights just for keeping their plastic card tucked inside your wallet. The card itself generates zero passive value.
You only get miles and lounge access for actually using the network.
Exactly. You have to swipe the card, book the flights, participate in the ecosystem. But wait, I have to challenge this premise for a second.
Okay, go for it.
If I'm just a casual retail investor, I honestly just want my 5% yield. I don't want to do homework. I don't want to participate in governance to earn my money. So doesn't forcing users to actively jump through hoops severely hurt mainstream adoption?
I mean, I see why you'd think that, but the data suggests the exact opposite, actually.
Really?
Yeah. When you remove passive yield, you force developers to build things people actually want to use. You incentivize real utility. And the major players in the space, they recognize this as a victory.
Oh, like Coinbase, right?
Exactly. Coinbase's chief legal officer, Paul Grewal, immediately came out in support of the bill. He noted that it legally protects activity-based rewards.
Which is huge for them.
Right. And more importantly, consumers are already making this pivot organically on their own.
Which brings us to that massive data point from the KOBC letter on Monday.
Yes. The KOBC letter reported that crypto payment card spending volume has surged 500% since September 2024.
500%. That's insane.
It's now running at $600 million per month. Users aren't just sitting on stablecoins anymore.
Right. They're actually buying groceries and paying rent with them. So the regulatory path for stablecoin utility is clearing at the exact moment consumer demand for it is just exploding.
Precisely.
So regulators demand utility on Monday. But where are users actually going to deploy those active digital dollars?
Well, that brings us to Tuesday, May 5th.
Right, which answers why we suddenly saw such explosive volume in the permissionless markets.
Hyperliquid launched its HIP-4 event contract.
Yeah, they stepped right into the ring to challenge heavyweights like Polymarket and Kalshi in the prediction market space. And they saw 6.05 million contracts traded on day one.
Which is staggering. That translates to over $6 million in notional volume.
Meaning the total underlying value of the assets being traded.
Right. And to understand why Hyperliquid could generate that kind of volume instantly, we have to look at the architecture.
Oh.
Hyperliquid isn't just an app built on someone else's platform. They are running a fully permissionless model natively on their own Layer 1 blockchain.
Let's clarify Layer 1 really quick for anyone who gets lost in the crypto jargon.
Good call.
It just means they own the base foundational network, like Ethereum or Bitcoin, rather than, building a secondary application on top of those networks.
Correct. They own the entire stack. And because of that, anyone can stake 1 million of their native HYPE tokens to instantly deploy a new outcome market.
Wow. And crucial to our theme of seamless utility, everything settles natively in their own stablecoin, USDH.
Yes, which eliminates the dreaded bridging friction.
Oh, thank goodness. You don't have to take your Ethereum, wrap it into a different token, pay a gas fee to move it to a Layer 2 network.
Swap it for a stablecoin and then finally place your trade? No, you just trade.
That bridging friction is the enemy of conversion anyway.
Exactly. With Hyperliquid, you can trade prediction markets on an election or a sporting event and then instantly use that same wallet, the same liquidity pool, to trade standard crypto perpetuals.
Which are essentially futures contracts with no expiration date.
Right. It's just an all-in-one terminal.
Okay, let me stop you there, though. Because the plumbing sounds great for crypto natives, sure. But Polymarket is a cultural Goliath.
Oh, absolutely.
I mean, you can't turn on a mainstream news network without seeing screenshots of Polymarket's election odds. So how does an upstart like Hyperliquid actually steal users from an incumbent with that kind of brand recognition?
Just by having slightly better back-end architecture, it wouldn't be enough. But it comes down to regulatory arbitrage and incentive structures.
Okay, explain that.
Hyperliquid possesses two structural advantages that Polymarket currently lacks. First, Polymarket and Kalshi are bogged down by stringent U.S. regulatory scrutiny, which limits their global reach and the types of markets they can offer. Hyperliquid operates outside of that jurisdiction.
Allowing them to tap directly into the incredibly deep crypto-native liquidity pools in Asian markets.
Exactly. They aren't fighting with one hand tied behind their back. And the second advantage, as Arthur Hayes pointed out in his analysis, is the HYPE token itself.
Right. Holding the token allows the actual users to directly benefit from the platform's upside.
And volume growth, yeah. Kalshi is a traditional regulated entity with no token. Polymarket has the cultural mindshare but lacks a native token ecosystem to, financially reward its most active participants.
So Hyperliquid is basically letting the community own a piece of the casino infrastructure.
That's exactly what it is.
And when you look at the projections for what that infrastructure will eventually process, owning a piece of it is staggering.
Oh, completely.
On that same Tuesday, Chainalysis published a report projecting that adjusted stablecoin volume could reach $719 trillion by 2035.
Trillion with a T.
Trillion. We aren't just talking about people betting on elections anymore. We are talking about the back-end rails for all permissionless, borderless global trading.
And you can guarantee that the smartest capital in the world is acutely aware of that 719 trillion projection.
Right.
The venture capitalists are not sitting this out.
Which pulls us perfectly into Wednesday, May 6th. Silicon Valley responds to this utility boom. Andreessen Horowitz, specifically their a16z's crypto arm, announced a $2.2 billion raise for their fifth dedicated venture fund.
And they promoted Eddie Lazarin to general partner yet?
Now, some analysts pointed out that $2.2 billion is actually smaller than their massive $4.5 billion fund from back in 2022.
Yeah, I noticed that too. But reading their strategy memos, that downsizing was highly intentional.
Oh, really?
They want to remain agile. What matters is where they are deploying that $2.2 billion. It is entirely aligned with the shift from speculation to utility.
Okay.
a16z's is explicitly ignoring market noise and retail token speculation. They are not hunting for the next viral meme coin.
So what's the mandate?
The mandate for this fund is targeting durable, on-chain utility. They're specifically underwriting companies building stablecoin adoption infrastructure, decentralized capital markets, and, prediction platforms.
It's just incredible to watch the chronological alignment of this week. Like on Monday, Washington, D.C. clears the regulatory path for active stablecoin utility.
Yep.
On Tuesday, a decentralized network proves massive consumer demand for permissionless prediction markets. And on Wednesday, the biggest VC firm in the space slams $2.2 billion on the table to fund exactly those two technologies.
Right. They are looking at the impending Clarity Act and betting their entire war chest on mainstream regulated utility. They're funding the transition to institutional-grade infrastructure,
Which the industry desperately needs.
And to emphasize how badly the industry needs this pivot toward legitimate tech, you only have to look at the other headline dominating crypto Twitter on Wednesday.
Oh, the ZachXBT report.
Yes. The prominent on-chain investigator published a massive report detailing the collapse of the DSJ exchange.
A completely brutal reminder of the old era of crypto.
It really was. It was a $150 million Ponzi scheme. The report showed bad actors laundering over $92 million through the protocol in a single week.
Wow. But the silver lining here, and how this ties into the whole maturation narrative, is how the industry reacted.
Right.
ZachXBT didn't just post it for clout. The report showed coordination directly with Tether, the Binance security team, OKX, and U.S. law enforcement to track the stolen funds and freeze wallets.
The industry is aggressively policing itself to clean house. The Wild West era of the crypto casino is basically being dismantled.
Making way for the institutional infrastructure a16z's funding.
Exactly. But here is the critical inflection point of the week. Venture capitalists in Silicon Valley aren't the only ones watching this maturation process.
Oh, no. Traditional Wall Street banks are realizing that crypto is finally legitimate enough and safe enough to offer to their most prized clients.
And Wall Street does not want to share the pie.
Never. Which brings us to Thursday, May 7th. Morgan Stanley launches this predatory strike on the crypto-native incumbents. They announced a pilot program for direct spot crypto trading right on their ETrade platform.
Specifically Bitcoin, Ethereum, and Solana. And this isn't just offering a Bitcoin ETF, by the way. This is direct spot trading.
Right.
And the weapon they are using is brutally competitive pricing. Morgan Stanley is launching this with a fee of just 50 basis points per trade.
Wait, 50 basis points. Let's translate that into plain English to really understand the threat here.
Good idea.
A basis point is 1/100th of 1%. So 50 basis points means they're charging a 0.5% fee on a trade.
That deeply undercuts the entire industry.
Yeah, because Coinbase typically charges retail users around 60 basis points. Charles Schwab is at 75. Robinhood, which built its whole brand on retail access, is all the way up at 95 basis points for certain crypto trades.
It's a bloodbath. And to pull this off without taking on the regulatory risk of holding the crypto themselves, Morgan Stanley partnered with Zero Hash for the back-end custody. That partnership is the key to the whole operation. Holding digital assets on a traditional bank balance sheet triggers incredibly punitive capital requirements from regulators.
Oh, I see. So by using Zero Hash to handle the actual custody of the tokens, Morgan Stanley offloads a heavy regulatory burden.
Exactly, while keeping the customer relationship entirely inside the ETrade app. The user just sees a seamless 0.5% trade.
I look at this and I immediately think of the Amazon Basics disintermediation strategy.
Oh, that's interesting. How so? Walk through the mechanics of that.
Okay, so think about how Amazon dominates e-commerce. Amazon doesn't invent a new garlic press. They let 100 third-party sellers risk their own capital to manufacture, market, and sell garlic presses.
Right, let them take the risk.
And once the data clearly proves there is massive consumer demand for a specific type of garlic press, Amazon swoops in.
Yeah.
They manufacture an Amazon Basics version directly, slap their own branding on it, leverage their massive global distribution network, and slash the price so low that the original pioneers go bankrupt.
That is exactly what is happening here. Morgan Stanley sat back and watched companies like Coinbase and Kraken spend over a decade taking all the regulatory arrows,
Fighting the lawsuits.
doing the hard work of proving that retail crypto demand exists. And now that the market is proven and legitimized, Morgan Stanley is swooping in with their own Basics version.
Wow, they have 8.6 million captive ETrade clients, and they are using that massive distribution to undercut the pioneers with a 50 basis point fee.
It's ruthless.
So my question is, if Morgan Stanley triggers an all-out race to the bottom for trading fees, how do native crypto exchanges, whose primary revenue comes from those exact fees, even survive?
Well, that is the existential question. For you, the listener, who just wants to buy some Ethereum for your portfolio, this fee war is fantastic news.
Oh yeah, cheaper trades.
It structurally validates the asset class and saves you money. But for a native crypto brokerage, this margin compression is a death sentence.
Yeah.
If the transaction fee for a spot trade eventually grinds down to zero, their primary cash cow dies. They have to evolve or perish.
Which brings us to the grand finale of the week. Friday, May 8th. We actually get our answer to how the crypto natives plan to survive the Wall Street attack.
They aren't trying to win a fee war on spot trading.
No. They are abandoning the battlefield entirely to conquer a new one.
Yes. On Friday, Payward, which is the parent company of the Kraken exchange, currently valued at roughly $20 billion, announced a blockbuster $600 million acquisition.
Of a fintech company based in Hong Kong called Roop Technologies?
Right.
But Reap isn't a crypto exchange. Like, they don't run order books for retail traders.
Not at all. Reap specializes in the exact underlying plumbing we've been talking about. They build stablecoin-powered payment rails. They facilitate cross-border corporate settlements. They issue B2B Visa cards across the Asian market.
Let's unpack the mechanics of why that matters. Because if a business in the U.S. wants to pay a supplier in Singapore using traditional fiat banking, they have to use the SWIFT network.
Which is a nightmare.
It can take 3 days to settle. It involves multiple intermediary banks, and it comes with heavy foreign exchange fees.
Right. Reap allows those same companies to settle instantly, globally, using stablecoins, bypassing the traditional banking friction entirely.
Exactly. Kraken is looking at Morgan Stanley attacking their retail spot trading margins on Thursday, and their response on Friday is to just spend $600 million to own the actual financial infrastructure of the future.
They are pivoting away from the consumer casino and moving into enterprise global payments.
And we actually got mathematical proof on that exact same day that this pivot is absolutely necessary.
Oh, the Coinbase earnings.
Yes. Just hours after Kraken announced the Reap acquisition, Coinbase released their Q1 2026 earnings report. They posted a $394 million net loss, with revenue plummeting 31% year over year.
Ouch.
The pure retail exchange model is bleeding out.
The writing is completely on the wall. The future of crypto is not just letting people swap tokens and taking a 1% cut.
No. The future is stablecoin utility, which the Senate validated with the Clarity Act on Monday.
It is borderless, composable liquidity, which Hyperliquid demonstrated with permissionless markets on Tuesday.
And it is owning the actual transaction rails of global commerce, which Kraken bought on Friday.
So let's synthesize all of this for you. When you consume financial news, it is just vital to separate the signal from the noise.
Okay, so what was the noise this week?
The noise was the daily price fluctuations. U.S. oil prices crashed below $90 a barrel. Michael Saylor did an interview talking about his strategy to eventually sell some Bitcoin to pay corporate dividends.
Sure.
Those are interesting tactical headlines, but they are fleeting.
And the signal? What's the real signal?
The signal is structural margin compression. The era of getting rich just by running an exchange that lets people trade tokens is over. Traditional finance will grind those fees down to zero. The real alpha over the next decade is in the infrastructure. It is the plumbing. Stablecoin payment rails and composable Layer 1 utility are where the trillions of dollars will actually flow.
So what should you keep your eye on next? Watch Washington.
Definitely.
The Senate Banking Committee is preparing to notice a formal markup session for the Clarity Act as soon as tomorrow. They have already circulated the draft text to committee members ahead of a potential Thursday vote.
Right. And if that legislation moves forward and gets signed, the buy and use stablecoin economy is no longer just a theory.
It becomes the permanent legal foundation of digital finance.
It will fire the starter pistol for the most massive wave of institutional adoption we've seen yet.
And we will be tracking all of those committee movements closely. Thank you for joining us for this deep dive into the week's sources. If you want to stay ahead of these complex market trends as they happen, make sure to follow Nifty Noon on X and subscribe to our newsletter on Substack for these daily briefings straight to your inbox.
And I will leave you with one final thought to mull over as you go about your day.
Let's hear it.
We are watching traditional Wall Street banks fight a brutal war to win retail crypto trading fees, while the original crypto native companies are pivoting hard to quietly buy up the global back-end payment rails.
Yeah.
If this trend holds true, by the time we actually hit that $719 trillion in projected volume in 2035, well, will the average consumer even know they are interacting with a blockchain? Or will crypto have simply become the invisible, frictionless plumbing of the entire internet?